It's almost fall, and if you pay attention to only one financial window all year, it's this one, guys. The last few months of the year, say September, but definitely October, November, December. This is your tax planning window. This is when the moves that you make can actually change what happens on your tax return next April. Not just filing a return, not organizing receipts, making real decisions right now that can reduce your tax bill. I've got the top strategies you should be considering this fall. I got that and more coming up. We are big believers here at Korhorn Financial Group that tax planning is not a once-a-year event. It's a year-round discipline. How nerdy is that? But if it means that you're going to pay less taxes over your lifetime, even multiple generations, I'm happy to be labeled a nerd. I self-do it. I will label myself a nerd because here's the thing. The fall is genuinely different. I'm not talking about pumpkin spice. This is when you have enough of the year in the rear view where you can actually know where you stand. You can see your income, you can reasonably anticipate what your deductions are going to be, and then you can make moves right now that still count for this tax year. Once January 1st hits, that window closes. It's not completely shut. There are some things that you can still do from January 1st until April 15, but many options are now off the table. So let's make sure that you use this time, this fall, these next few months to improve your tax picture intentionally. Where do you start? Before you do anything else, and I mean anything, before you get any creative strategies in mind, you need to do a tax projection for this year. A tax projection is exactly what it sounds like. Again, a little nerdy. You take everything you know right now, your income, your withholdings, your deductions, and you project that out to December 31st. You basically create a mock tax return based on the current trajectory that you're on. This tells you what's your likely taxable income. What bracket are you sitting in? Are you going to owe any money this April, or maybe do you stand to get a refund? This is the foundation. Every other tax planning strategy that we're going to talk about on this list, every single one, depends on knowing where you stand right now. Without this tax projection first, the rest are just good tax planning ideas. You've got to know, well, does this make sense for me right now? Build out that projection first. If you're going to be in a lower tax bracket this year than next year, that changes everything. If you're sitting right at the edge of a tax bracket, there are moves that you can make. Do the projection first. Everything else flows from that. With that foundation, now you can get strategic. The first one is obvious, but you'd be surprised how many people get to December and they realize they left money on the table. If you're still working, look at your 401k, look at your 403b, your workplace retirement plan. Are you on pace to hit the maximum contribution limit? If you're not there yet, you may have time to bump up your contributions. Maybe in these last few months of the year, even a few extra paychecks at a higher deferral rate can help you close the gap meaningfully. Help you with your taxes, help you with your retirement plan, help you with your investments as well. Same thing with your HSA, your health savings account. If you have a HSA eligible, high deductible health plan, and you're not maxing out your HSA, you are leaving a triple tax benefit on the table. The money goes in pre-tax, it grows tax sheltered, and then as you withdraw the dollars and spend it on qualified medical expenses, it comes out tax-free. That's about as good as it gets, guys, and you've got a few months here left before the end of the year to ensure that you max out that HSA coming right out of your paycheck. Next, after funding your tax shelters, you then need to optimize your tax shelters. You know, this is one of my favorites, and the fall is the time of the year where you need to definitively rule it in or rule it out. I'm talking about a Roth conversion, which means you're taking money out of a traditional IRA or your pre-tax 401k and converting it, moving it into the Roth side of your 401k or your Roth IRA. When you do that, you pay income tax on the amount that you convert, assuming it's pre-tax dollars in your IRA and not after-tax money, it's taxable. But then that money grows tax-free forever since it's now in the Roth. And in retirement, you pull it out tax-free. Now, who's this for? This is especially powerful if you're in a lower income tax year right now. Maybe you're retired, but you haven't yet turned on Social Security. Maybe you had some business losses this year, or maybe some extra business expenses. Maybe you just had lower income for whatever reason. This is the window. You can convert a chunk of those dollars, those pre-tax dollars, at a lower tax rate, and it's going to help you avoid paying tax on those dollars out there in the future. This is not for everyone. You need to run the numbers. You need to build out that tax projection and then try it on for size working with your CFP. But this fall, that's the right time to ask this question and the right time to answer it because Roth conversions, they have to be done by 12/31. This next idea applies not to your tax shelters, but to your taxable accounts. So not your 401k, not your IRA, those of you that have regular brokerage accounts or non-retirement accounts that you're investing after-tax dollars into. Tax loss harvesting. That's the strategy of selling some of your investments that maybe are down and then you realize that loss. And I know that sounds weird. Who wants to sell a loser, especially one where, yeah, the market's been up right now, but maybe you've had some investments that when you got into it, you're actually a little bit underwater. Here's why that can make sense. That realized loss can offset gains that you've taken somewhere else throughout this year. If you sold something that has gone up, then you've got a capital gain. Well, harvesting losses cancels that out dollar for dollar. And if your losses end up exceeding your gains, or maybe you don't sell anything with the gain, you just focus on the losses, you can actually deduct up to $3,000 of that against your ordinary income, creating a real tax deduction of offsetting a much higher tax rate. Be aware of wash sale rules though, meaning you can't just sell an investment and immediately buy back that exact same investment, but you can sell that one and then buy back something similar, even if not identical. If you've got gains and you've also got some losses sitting in a taxable account as well, fall is the time to be opportunistic and evaluate this and take some action. Next, if you're giving money to the church or to charity, fall is the time to make sure that you're doing it in the most tax efficient way possible. Most people write a check or swipe a card or pay online. That works. But there's often a smarter way. If you're age 70 and a half or older and you have an IRA, you can make what's called a qualified charitable distribution, something called a QCD, and you can actually send a significant amount of money, over $100,000 this year, directly from your IRA, directly to the qualified charity. That money is excluded from taxable income entirely, doesn't even land on your tax return, but yet it can satisfy your required minimum distribution when you're age 73 and higher. So it's really a double win. And if you're not yet age 70 and a half, and you want to give some appreciated stock instead of cash, that's another highly effective strategy. Open up your donor advised fund if you don't have one already. Maybe now's the time for you to get one. Donate your appreciated stock to it, and then use the cash that you were going to donate to the church, buying back the stock that you just donated inside your brokerage account. So those are just a few of the tax planning considerations for you this fall, but here's what each of those moves has in common. They don't happen by accident. You need to be intentional. They don't happen reactively. You need to be proactive in planning ahead. And they don't make sense in a vacuum looking at just one area of your finances. You need to take a comprehensive approach. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on, take your next wise step in your financial life.